so let's talk about risk management, right?
Yeah.
Naturally, because of the bias of RV in your four models, you're going to keep one eye open late at night for these type of tail risks. So my natural inclination as an allocators, I'm going to expect to see some response either from the diversification of the portfolio or some form of drawdown management.
Yep.
Now, the flip side to that, if you over diversify, then it eats away at absolute returns. Meanwhile, if your drawdown management is too aggressive, then you get whiplashed, or you're not in a position for the mean reversion. What's your view? How do you approach that?
Yeah, so
kind of polarized problem.
Yeah, it is always a key consideration for the kind of strategy we work on. Just like we didn't finish the Russia situation, right?
Russia situation.
It's just like that because I remember right before the Russia war, Russian ruble was the market consensus long position. It's a great position from every aspect.
Yeah.
Fundamentally, technically, It's a great position. Almost everyone's long. We were long as well. But our signal was able to reduce the positions substantially before the war occurred. Of course, it's not like the model actually can predict the war. It happens to be that the market condition during that time lead our signals to basically guide this reduction of position.
Okay, so let's zero in on that. What was happening? What were the indicators that were triggering your model to reduce position? Like what was the model seeing in the market that was alerting it to some fragmentation and maybe consensus was not what it should be?
Well, because our approach is, you mentioned early on, I consider it a multi-strat approach. And so at any given time, our portfolio is not dominated by a single a major theme or one investment idea. So every signal I consider incorporate into the framework is an investment idea. We have multiple such investment ideas. Some of them are fundamental driven, some of them are price driven. Even within the price driven signals, there might be seemingly conflicting signals. Some of them are more mean reversion nature, contrarian nature. Some of the signals are more following short to medium term divergent trends. So these signals at times will give you conflicting signals. They will bring in positions that offset each other. But I call it a multi-strat approach, is that I consider these individual signals as, for example, the individual PM teams in a multi-strat fund platform. Right? I think the key idea is to let each one of these independent alpha sources to
play themselves out.
Yeah.
Right. And is that what happened with the ruble?
So what was happening there, of course, we have some, if I remember correctly, some of the market price driven signals are detecting, not necessarily related to what's going to eventually happen, but just market conditions that have changed, resulting us having a situation, these signals are no longer aligned, because that's the time when we take the larger positions. Because our approach is
a confluence of multiple indicators.
Yes.
And when the confluence starts to unravel, that's when it becomes a weaker signal. As an aggregate net signal becomes weaker.
Yeah.
And because it was weakening, you started to wind down or reduce exposure as a result.
Yeah. It's our longer term fundamental signal. We're still pointing to long ruble position, just like a market consensus. But the shorter term signal, some of them have turned, right? Providing a different view, essentially, at the situation, and offsetting the positions from the fundamental signals. And that, in aggregate, resulted as smaller positions. Also, part of it is probably the risk being observed in the market, because risk is another key element of the entire framework, because the whole framework is based on quantitative method of constantly balancing the return opportunity the model sees and the risk situation model sees, because we have a comprehensive risk estimation process embedded into the framework. So any of the implied volatility picking up in the Russian ruble market will be reflected in our model. And our principle is that if your volatility or just the riskiness of the position changed while your return opportunity didn't go up proportionally,
right? So you might look
also
at things,
reduce position.
Right. So you might look at things like the Greeks offered the options, for example. Right. There might be a big dispersion there, which might affect price in combination with price, might trigger you for short-term bearish, even though it's long-term bullish.
Yeah. FX option market is a very interesting market where you can observe the FX option prices, which essentially it's equivalent to what we call implied volatility.
Yeah.
So the price of the FX options reflects the trader's
Sentiment.
subjective measure of how risky these currencies are. Usually that is the most timely indicator to capture the sentiment change and anything that's potentially popping up. So,
and is the strategy, is your risk management framework, is it latency sensitive in terms of the trades, or is it just latency real time in terms of its monitoring from the indicator?
Well, our strategy is what I consider a medium frequency strategy. Our average holding period is 2 to 4 weeks. So it is not the kind of high frequency strategies that rely on real time, like intraday data to react very quickly to what's happening within the day, right? The strategy we have here, being a medium frequency strategy, we respond to price movements or data changes over a few days time horizon. So we will not react immediately to what's happening intraday. Because over my observation of these years, that a lot of times the intraday changes
or can be extreme, but they also
a lot of times they
revert.
Yeah,
they revert.
So I mean, it's always there are very nice high frequency intraday strategies that people build on FX and interest rate strategies, but to be a strategy of sufficient capacity, by definition, almost, it's hard for you to always capture that kind of very short-term moves. So if you build your strategy entirely on these very, very short-term signals, usually the capacity can be fairly limited.
I think that's a good segue back into the risk management side. When you build the portfolio construction arm of your model, right? How do you look at, on one hand, I get the sense you look at obviously covariance between the different markets and instruments, but you're also looking at there must be a correlation matrix of sorts, right? That keeps it relatively low, is what I sense. Now, the second part of my first question had to do with how do you ensure that the alpha is there? Because there's a diversification, which if it's too diverse, it kind of weeds out the alpha in a way.
Yep.
And so how do you maintain the performance to be on the right side of the curve because of that?
Yeah, so as a quant manager or in general, quant approach, it is really about a number game. That is, you want to make as many independent bets as you can. So that links to your low correlation concept, right? So we use cross-country relative value as the source of these different independent bets. Because if you make enough such independent bets, and if you have a history or data to guarantee, not necessarily guarantee, say, hitting ratio or winning probability, and he said it's like a 55%, 60% chance of winning, right?
Which is very high.
Even lower than that, right? If you have these bets, if you have many of them, and they are independent from each other, then if you aggregate all of them together, you're almost guaranteed to win, just like the casino operators, right? So in our case, it's really how do you do that? How do you make sure these are actually independent from each other? Because many cases, it's that seemingly it is independent. Even at the time of crisis, they actually
they don't. Correlation goes to 1.
Right. So that's the most difficult part. Yeah, so diversification is definitely the key to this whole approach. We diversify across different signals, right? These signals are reflecting very different stories of how alpha could potentially be generated, different rationales, different theories, essentially. Yeah, so you do face the risk of over-diversification. In our situation, I would consider, first of all, these signals are really diversified expression of investment thesis and ideas. And because of the medium frequency nature of the strategy, our data is essentially limited. That really doesn't support us to employ a very large number of signals. You asked the number of signals here. We just have 12-ish signals in each of the FX and interest rate space.
Got it.
And so I think is kind of important point behind this is that even though this is a quant approach, because of the medium frequency's nature, it is not a data-driven approach. Even though my background was in machine learning, data mining, given the data we have is really not big data. We use daily frequency data to build our models. That doesn't afford us the luxury of all that searching in the data space. For example, trying out thousands or tens of thousands of signals and pick the best.
Right.
That can give you a very perfect fit with the history, but that runs into what we call an overfitting risk.
Yeah.
Because you can have a perfect fit with the history, but
it's not forward-looking.
yeah, a lot of times it might be the more you search, the greater the risk for your model to be not very good at predicting the future.
Yeah.
So,
or at least not being ready for it. May not predict, but it certainly may not be suitable for managing future risks. Right?
Yeah. So instead, our approach, the reason why we only have a limited number of signals compared to other quant strategies you might have experience with, we do not start with data. We start with theory, literature, rationales, ideas. We first need to get that past the first kind of test.
Right. So these are
even before looking at data.
These are almost fundamental causalities, which I'm trying to frame it. These are fundamental causalities in the macro space, cause and effects, which are correlated not arbitrarily, but have a logical reason for that correlation, right?
Yeah, or rather low correlation.
Or low correlation, sorry.
Across
or
signals.
Inverse correlation across signals. Because that's essentially the objective.
Yep.
And this is to help alleviate or help mitigate some of the problems where when markets start to move or they start to crash and unwind, correlation goes to 1 in normally uncorrelated asset classes, right? So I guess feasibly, it makes sense for you and the team to monitor these causalities very, very closely. So what is that process like? I mean, do you review it on like a monthly basis, a weekly basis? How often do you reassess and re-underwrite that logic?
Yeah, so this is actually related to your earlier question as well. Earlier question about all these big idiosyncratic developments, huge volatilities in the market, Russia situation.
Exactly.
How do you manage the drawdown?
Well, first of all, is it noise or is it a significant departure in that causality and therefore correlation?
Yeah, so each one of these signals we employ, right? We use them because then they make sense, first of all. And then we also have empirical support. Within our context of relative value or directional portfolio, it does give us very long-term, decent risk-adjusted return. So by that statement, we're saying that if you follow this kind of pattern to make relative value investment, more often than not, based on history, you're going to win.
You're going to win, yeah.
But that is a statistical statement, right? I think for all the quantitative investment professionals, I mean, the super important question always in mind is there is always this risk that statistically working relationships in the past, very successful signals, there's always risk that it can just stop working today, or you may just produce a negative return for the next 2 years.
Right.
So that is, you cannot blindly believe in what the data is telling you from history, right?
And this is coming from a data scientist. This is coming from a PhD in information science, 5 years at Bernstein, another 7 years at PGIM. Right? Code is law, and then data is law until it's not. That's the takeaway I'm getting, which is actually quite profound.
Yeah, so you learn that, I mean, when you're in the market, you learn that firsthand, like during the COVID time, right? When it started, so many market development dynamics, so many data patterns you observe across different asset classes.
Yeah.
They experienced that kind of drawdown.
They were all unraveling, yes. Right? Their drawdowns, correlation went to 1.
Yeah.
Everything was getting crushed.
Yeah, so you asked me, how are we addressing this problem of controlling for drawdown, controlling for these big impacts, idiosyncratic developments? How does that impact portfolio? So we first rely on diversification across signals. Diversification across many countries, right? We have so many countries and so many instruments to express our views, to express the alpha positioning. That's the first step. But then the second step is really just related to this. In order to address this always existing risk of something that has been working so well in the past suddenly stop working, that is part of a kind of improvement to my whole methodology, that is having a statistical based method to constantly conduct this disciplined drawdown control mechanism
Okay.
at all levels of my portfolio.
So that means on position level, portfolio level, is it statically priced or is it dynamically priced?
Well, it's like how often do I monitor, right?
Yeah.
We monitor it every day. So essentially, you can think of it as statisticians or data scientists. We do these hypothesis testing every day using the data we have.
Yeah, to be clear, so when you're talking about the correlation and covariance between the different factors and the indicators and the strategies. And then secondly is drawdown control. So drawdown control is more related to stop loss management, exposure management.
Yeah, so this is really about what you believed to be a working pattern that will generate alpha for you over the past, whether or not the data you have seen recently gives you enough evidence that you now can conclude there is decent deviation from the historical norm, then that you need to do something about it. And we do that at all levels of the portfolio. So at the total portfolio level, sub-strategy level, of those 4 sub-strategies, and between relative value and directional portfolio, and then all the way down to single signal level, right? So that is essentially, we are keep on monitoring these historically proven patterns, whether or not they are breaking down at any given day. So we constantly do that. And to me, this is an a priori kind of treatment. I mean, it is always a art rather than science here, because there's no one can claim you have a perfect drawdown control mechanism, because once you, like you mentioned earlier, once you do drawdown, there's always the risk of missing out of the rebound and being whipsawed and all that. But my take is that even if after doing all this drawdown management, comparing to a kind of backtest portfolio where you don't do any of that, even though you actually sacrifice some returns, I think it's still a must to have. Because it's a priori. You don't know what's going to lay in front of you. Just like the peso problem, what hasn't happened in the past is not going to guarantee to not happen in the future, right? So,
and I think this is particularly important for some managers who are spinning out from larger shops, or even more specifically prop shops, where they've had unlimited capital and not had to deal with monthly subscriptions and redemptions. Having mechanisms like this in place helps your investors, regardless of whether they come in on day 1, day 2, or 6 months later or a year later, they should be enjoying or experiencing a similar investment profile. Right?
Yeah, so because essentially a lot of that is based on your peak to trough kind of, I mean, like most standard way people do stop loss is just that peak to trough drawdown, how much percentage, and then you just do some action after a certain number were met. We do a little bit more than that. Just it's a statistical method looking at not just the size of the peak to trough move. We also look at the volatility of that and how you came to that.
Where we are on the curve.
So it's the whole experience, the entire experience.
So I want to ask, and I think we've had a couple of sessions, sat in on a couple of sessions before where the allocator asked, why a high volatility strategy? And just so that the audience is aware, right? At least historically, the strategy has been relatively low vol. And what you've made a conscious decision to do is to target a higher vol approach to the strategy so that you can achieve higher returns, but also with it higher volatility, roughly in the range of 20%. So I got to ask, why? In a world where it seems like a lot of investors, at least prima facie, are running away from risk, why are we providing this product to them?
Yeah, so in this kind of quant strategy, right? So we have this flexibility, like where you want your target volatility, because we position our portfolio always with this target volatility in mind. So we can either choose a lower volatility target, 10%, or like this 20% level we eventually chose for the fund. By the way, in my previous firm, the volatility we were managing for different accounts is much lower than these, because these are just alpha overlay strategies, not like the entire bond fund, maybe the annualized volatility target is only below 10%, for example. So why 20% versus 10%? That is a big question. We debated a lot. I eventually decided on the 20% because I think there are sufficient investor base that if you think about it right, that if you just hold S&P, for example, right, any other country's equity index, the volatility experience you are getting is usually over 20%. So of course, people are a lot used to taking equity exposures and might not be so used to having a risk exposure to FX and rates in this 20% level. But if you can overcome that sort of bias, if I can use that word, because from quant's perspective, it's all return sources, right?
Right.
If you're comfortable taking same amount of risk as S&P 500, then taking a 20% risk shouldn't be such a hard thing.
Right. So what you're saying is that the value proposition is that if you're comfortable with equity-like volatility,
Yep.
but uncorrelated returns
To S&P and
to
other
S&P,
beta.
then this could be accretive.
Yeah. And our Sharpe ratio is, as a hedge fund product, you definitely should be offering much higher Sharpe ratio than S&P 500.
Yeah.
Although S&P 500 had a pretty good performance.
Oh yeah, well, it's only going in one direction, right? Especially the last 3 years.
Yeah, but historically, if you have the greatest length of history on S&P, that exposure, the max drawdown you get from that is sizable, right? So my idea is that if investors are comfortable with this level of risk taking, then we argue that we can provide unrelated return to all kinds of market beta. We have tracked the correlation of our returns to many different market beta indices. Its correlation are pretty low. Even these 4 sub-strategies we have here within the framework, even between the FX strategy like G10FX and EMFX, the correlation are almost close to zero.
Wow.
Because each one of them has relative value as their main risk-taking allocation. So you have unrelated return to S&P and other betas, and you have decent Sharpe ratio. We are targeting for that 20% vol, we're targeting 30% return on an annual basis. And then, of course, there are institutional investors who are not used to taking really 20% level of vol. They probably are looking at 10% vol product in a usual situation.
Yeah. But then there are a lot of products in that space too, right? So you get really, I feel like the moment you drop to that level, right? High single digit, low double digit, you're getting to a space where on one hand, it's a sweet spot for what private bankers and gatekeepers and IFAs are targeting for return for their clients. But at the same time, it's a very competitive space. At the same time, you have this risk-free rate, which is still relatively around 5-6%, plus whatever premium you have on the risk premium for actively managed strategies. It's a high hurdle rate. So if you're going to compete, in a way, as an outsider looking in, I kind of see the logic of targeting 20% return, because if you're going to compete in a market which is an increasingly competitive and polarized market in the hedge fund space right now, you're going to need to have punchy returns.
Yeah, it's interesting you mentioned that U.S. interest rate of 5% and that hurdle rate, right? What I mentioned about that 30% return, I should emphasize it is excess return. So we, being a kind of a strategy that using derivatives as like FX forwards and interest rate swaps, the U.S. interest rate return, our base currency is US dollar, right? So the U.S. interest rate return is actually our base return. So when we get investment into the fund, the first action we do is to buy U.S. bond, short-term U.S. bond. So we don't take any interest rate risk from that bond purchase, right? And then we use the bond as collateral for taking these derivative positions to satisfy the margin requirement.
So you're naturally hedged against the dollar already.
Yeah, so we also are naturally getting that base return of 5%.
Yep.
So when we say we target 30% return, we actually target 35% total return in the current environment. And then you mentioned that, this 20% choice is putting us into a slightly different segmentation
positioning.
Right? I was also just maybe semi-naively thinking for those institutional investors who are only looking at 10% vol product, if they can just think about the problem in a way that, say you have an interest of 100 million in a 10% vol product, you can just put in 50 million in this 20% vol product.
It's true.
The return you're getting is equivalent, right?
The risk you're taking is equivalent,
but
the target returns are juicier.
Yeah, in terms of dollar return.
Dollar return.
Yeah, it's the same experience, and you pay a little bit lower management fee.
But again, the key is that it's uncorrelated to what the equity return profile is like.
Yeah.
Right. Otherwise, you might as well just put the money in S&P. Call it a day.
Yeah, and you have all these large multi-strat and platforms, Millenniums and the world. very good Sharpe ratio. I should say that like when we talk to our institutional investors who are interested in us, I think one of the aspects they look at indeed is the size of the return is definitely one of the consideration, because some of these very successful, large, established hedge funds, they target lower volatility for different reasons. They choose that is the level of volatility they want to operate on.
So I got one more question for you, and this is more stepping back. You have conversations in your circle on the macro side about what's happening with the big narrative right now, especially with U.S.-China relations, and not just U.S. foreign policy. I had a look at the bond auctions a couple of weeks ago. As of the time of this recording, 2 weeks ago, there were bond auctions very, very weak on the 2-year, very, very weak on the 5-year. But the longer-term ones seem to be higher in demand, but that's because sovereigns need to invest into those anyways. But 2 years was very, very weak. Market makers had to come in and pick up the balance. This theme of de-dollarization, and the question is not whether or not your models account for it, because I know they don't. This is a systematic strategy. But what's your view on this, and what's the consensus that you have amongst those in your space?
Yeah, I think the de-dollarization, maybe a broader context, is really what we touched upon
Reserve currency.
earlier. And not just that, I think it's the shift in the volatility environment. We shift from a low volatility environment post-GFC, the great financial crisis, to post-COVID, high volatility regime. So I think a lot of these are playing a role, making us feel that we are heading into a very different time than the past 10, 20 years.
I look at it as symptomatic is what I'm trying to, I guess I'm alluding to. The volatility is symptomatic of a larger narrative. I don't know if it's noise or not, to be honest, because the whole prospect, right, of U.S. losing or weakening in reserve currency status is almost unthinkable, right? So many, not just allied countries, but also non-partner countries, even now like Hong Kong, for example, is highly dependent on the peg and on the stability of the U.S. dollar, right? When you look at this type of transition, if you were to, whether in your research or statistically, is this something that's a clear and present danger, or is it so long-term that we shouldn't even need to worry about it?
Well, at least from my narrow perspective of just focusing on the strategy and monitoring the performance of the signals or data patterns we have been using to generate alpha, we have seen short-term drawdowns of these signals or short-term non-functioning or being anomaly from the long time history of these data patterns during the COVID time, right? But we don't see permanent retirement of any signals. That is a indication that, at least in this particular space of country relative value space, those patterns still work. So we are still maintaining this similar market dynamics that have been working for so long.
Or is it suppressed signals that...
Well, it's
going back to our earlier discussion, is it really suppressed signals that we should pay attention to?
Well, yeah, I mean, that's always
I'm speculating.
a possibility.
A joke.
But the big thing we do observe is that with this higher volatility regime we head into, right, related to the dollar de-dollarization, related to the geopolitics, many other factors playing, we do see larger return opportunities comparing to, like, naturally, right? You see 2022, this huge global interest rate move. I mentioned all these directional risk-taking managers being successfully capturing that. That kind of opportunity, that kind of environment, not only brings directional trend and directional return opportunity, when you have such a big change in the system, shock into the system, sustained change in the system, you see big dislocations of relative value as well, right? And also you mentioned about the U.S. Treasury auction, right? So I remember clearly that during those times, right, the U.S. Treasury should be the risk-free asset, right? Can you imagine that the daily moves on the U.S. 10-year rate to be comparable to countries like Brazil and Colombia during those times, right? So this is totally a different world. If someone didn't follow the market, someone who were in the market, in the interest rate market, right, and didn't follow the market for some years and then just suddenly come into the play, looking at what's going on, this is...
If I were a caveman and I was in a coma for 20 years and I woke up, I was right? I was an interest rate trader back in the 80s, and I wake up and I see movements like this in the 10-year, 20-year.
Yeah, it's totally unimaginable, right? So that brings the situation that all of these movements, these volatility, in fact, brings a lot of the return opportunities in the kind of strategies we work on. So in both FX and rates, if you look at the recent history, in such environments, there are chances that, like in terms of annual return from these asset classes, you can generate more than double the usual size of return based on the long-term history. So that's one thing, one kind of takeaway I kind of see from these big changes in the environment we are facing. This is, I mean, many people say this is the time of the macro investing. This is the reason I think macro opportunity do show up much more so than that low volatility regime post GFC.
Okay, so one last question. We talked about Japan. That was an interesting opportunity. What are you seeing next? I mean, your personal view in terms of the EM market, because that's where a lot of the great opportunity is. You're seeing great dispersions across EM, especially as they shift and they're moving through different growth cycles, whether it be Korea or India, for example, which is going through a tremendous structural change.
Yeah, so I follow the market. I had all these discussions with my prior colleagues in discretionary portfolio management, but I always think my personal discretionary view do not necessarily play any importance in the portfolio.
But I'm just asking just asking your personal view. This is outside of the portfolio.
But just combining with the knowledge I gain from looking through the lens of my model in terms of opportunity set, right? So we have different kinds of opportunities. We have those really long-term opportunities that show up in the data that reflect really these long-term divergence of patterns. So it's, for example, Asian country versus other regions. It's you
mean Asian versus
Latam, for example, right? Very slow motion move. If we're looking at very, very long term. You see the quality of development difference show up in return data. Maybe shorter term, it's totally different. For example, post-Russian war, this divergence between the outperformance of Latam is a dominating theme because they are far away from the war zone. They also benefit from the most kind of interesting topic these days, the friendshoring, nearshoring, right? A lot of the flows into Mexico. But if you look at really long-term development over decades, the quality of the development in the Asian countries do show up in data. So I firmly believe that kind of long-term dynamic is going to continue to play. Because after all, the Asian region is a growth engine for the entire world, right? So although there are challenges and variances, but that might continue to play, right? And then, of course, these what I just mentioned about these geopolitics-driven patterns, and that can also manifest them in these cross-country relative value opportunities.
I'm excited to see how this plays out, and in particular, when we look at fund flows and macro flows, like in the last session we had, which was about the ABC trade, the anything but China trade, and you're looking at places like Latam, Mexico in particular, really benefiting from trade flows coming out of China and then using them as proxy for entering into the Americas. ASEAN benefiting tremendously, and so Korea as well. And how this sort of shifts some of the causalities and the relationships, I think time will tell. But I'm very, very interested to see how these could potentially be long-term structural changes. But at this point, obviously, it'd be foolish to ignore still the main growth engine to be coming from Asia, for example.
And those are the really longer term developments or dynamics. Shorter term, for example, specifically to the environment and the opportunity set we face, like this year is an election year. Many elections across the world. Just beginning of this month, these 3 election surprises in the emerging market countries in South Africa, in India, in Mexico, right? All of these drive all kinds of market moves, and all of that are potentially return opportunity. Of course, it could also be really messing up people's portfolios and returns. But by and large, the observation is that when these big moves, big shocks happening,
Yeah.
more often than not, we are seeing better return opportunities, like the COVID time, all these huge shocks into the system, both directional and relative value opportunities eventually show up.
Well, Zan, congratulations again on the launch of your new fund, Kaiyuan Macro. It's going to be a big hit this year. Looking forward to checking out with you again, maybe in the first quarter, maybe the first 6 months after up and running.
Yeah.
And good luck, and we'll talk to you soon.
Looking forward to that. Thank you.